What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be talking about the importance of having a good credit score. And if you don't know what a credit score is, I implore you to take a look and do some reading up on what credit scores are, because they're extremely important to your life, whether you believe it or not, or whether you know it or not. So in today's video, we're going to talk about how they're calculated. We're going to talk about the importance of having a good one, and then I'm just going to show you a scenario in a spreadsheet, again, which I have built here, and the difference between a good credit score, a medium credit score, or a average credit score, and a bad credit score. Okay, so without further ado, let's go ahead and get right into it. Okay, so the first tab that I have open here is the factors involved in calculating your credit score and the percentage in general which are used to calculate them. Obviously, every different credit bureau has their own models and calculations and factors that they want to implement. These are the most generic ones, and this one is coming from Equifax. The other main credit bureau in Canada is TransUnion, but TransUnion will also calculate your credit score in a very similar way. So the first factor here is your payment history, and this is very straightforward. Any debt obligations that you have, whether that be a credit card, your mortgage, an auto loan, if you've ever missed a payment, that's going to significantly impact your credit score. It's worth roughly about 35% of your total credit score, okay? And that is your payment history, by far the most important factor. So if you have ever missed a payment, you'll definitely notice a ding in your credit score. The second factor is the used credit versus the available credits. And this one's kind of interesting because they don't want you to be using credit to the max, and maxing out your credit cards and having like 3 or 4 different rental properties when you're only making like $50,000 a year. But they also want you to be using a minimum threshold of credit. The credit bureaus don't per se give out the minimum threshold that they want you to be spending, but they also don't want you to be maxing out your credit cards. So this one is worth roughly about 30% of your total credit score. The third factor is your credit history, and this is how long you have actually had credit, or how long you have been using credit cards, or how long you've had a mortgage. What's your history like? And obviously, as time goes on and the amount of payments you've made and that you have not missed, your credit history score is going to go higher. It only accounts for about 15% of your total score, but this is important, and I guess I would implore anybody watching this video, if you're 18, get a credit card. And I know that probably sounds weird because you probably wouldn't trust 18-year-olds with a credit card, but it's important to start building your credit early, and this will affect the interest rates which you can achieve later on in life. The fourth factor is the public records, and this is basically if you have any type of derogatory public records against your name, whether that be a bankruptcy or some sort of collections issue. Obviously, they're going to ding your credit score. This factor is worth approximately 10%. And the last factor of calculating your credit score is the inquiries, okay? So the more inquiries you have, generally the more they will ding you on your credit score. For whatever reason, if you are, let's say, shopping around for a mortgage or shopping around for an auto loan, the creditor has the right to actually check your credit score, and every time that you do get checked, they will ding your credit score for whatever reason. Now, typically these creditors require your consent in order to pull your credit score, and these are what are called hard pulls. There are things which are called soft pulls, which you can check your credit score for free, and that's what I have up here on the second tab here, which is Credit Karma, okay? And so this video is not sponsored by Credit Karma, although I did apply to their affiliated program, but they denied me because I didn't have enough traffic on my YouTube channel. Cheers, Credit Karma. I'm still showing this to you guys because it's a absolutely free way to check your credit score at any given time. And it's not your official FICO score, but it's very close to your official score. So all you need to do is sign up on their website or on their app, and they'll ask you for some personal information, and they will basically give you what your estimated credit score is, and it updates on a weekly basis. So you can see up here on the screen here my credit score, and it's broken down into a few different categories. Anything above 800 is considered stellar. As you can see here, I'm just right underneath 800 at 799 in that 720 to 800 range, which is the second tier. Anybody in that 800 plus range is going to be getting the best available interest rates. The other good thing about Credit Karma is that all your public debts are actually on their website. I'm not gonna, show you mine obviously because there's some personal information on there, but it does have your entire catalog of debt and will show you what's outstanding in terms of your credit cards, your auto loans, and your mortgages, or mortgage. Maybe you have two, I don't know. Anyways, the other thing I really like about Credit Karma is they give you options in terms of credit cards you can apply for, and they will actually offer you specific credit cards based on your credit score. Okay, and there's different types of credit cards here. You can see some are more tailored to rewards. You have cashback, MasterCards, building credit cards, as well as cutting cost credit cards. So really cool app, really cool website. Definitely check them out if you want to know what your credit score is. And they'll also tell you whenever there is any type of inquiry on your account, hard inquiries. Okay, so signing up for Credit Karma won't actually ding your credit reports, and it's actually completely free. So it's a soft pull, completely free. The only downfall is it's not your actual true FICO score, but it's very close to the final, to your official score. So I have a couple of other tabs here open that I just had kind of like read through before making this video, and I'll scroll through them so you can see, but to me, the main benefit of having a good credit score is this first one here. Low interest rate on credit cards and loans. And what I've done here is I've built a spreadsheet to show you the difference that an interest rate can make over the life of your mortgage. In fact, what I've shown here is actually just the first year of a mortgage, okay, the first 12 months. So what I've done here is I've built out 3 different mortgage scenarios with pretty much the same assumptions except for the interest rate. So we have a mortgage amount of about $500,000 in each scenario. $500,000, $500,000, $500,000. I'm assuming monthly payments, 12 payments a year, over 25 years. Okay, the only thing that's different is the interest rate. Okay, so I have a 2% APR, 2.5% APR, and then a 3% APR. The next step to calculating this is the monthly rate, and all you need to do is go 1 plus the rate to the power of 1 over 12 minus 1. I know it's a little bit counterintuitive here, like why can't you just divide this by 12? Taking something to the exponent will, or to the power of, will factor in compounding. Okay, so what you do here is, I'm splitting hairs, but what it's gonna do is, you see how it's 0.16516? If you just divide 2% by 12, you're gonna get 1.666666. Okay, so it does make a difference. Make sure you add the exponent there and don't just divide it by 12. Okay, and then all you need to do is add a payment function to get your monthly payment. And then what I've done here is I've broken down the payments for 1 year, the principal which you're paying off, the interest which you'll be paying, as well as the beginning and ending balance of the mortgage. Okay, so this is best case scenario here. This is a great credit score. Okay, you achieve a 2% rate. At the end of the year, you've paid $25,000 total, and you've paid about $15,600 of your principal off, while paying $9,700 worth of interest. Okay, ending balance $484,000.4 left to pay. Okay, if we move to the second scenario here and we look at the 2.5% rate, you can see that the monthly payment is not only higher by about what is it, like $100, $120. You end up paying more throughout the year, and you actually end up paying less in your principal and more in interest. And your ending balance is higher than the great credit score here. Okay, so this is your average credit score. And then we're going to go down to the final scenario here, which is a bad credit score. Okay, and what I've assumed here is a 3% APR, and you can see the monthly rate is about 8 basis points higher than the great credit score. Okay, so just the difference in payments per year, not only are you paying about $3,000 more total for the year, your monthly payment is much higher, your total payments for the year are higher, you actually even pay less in principal. So you're getting dinged twice, okay? Your monthly payment is higher, and you're paying off less principal, and you're paying more interest, and the ending balance of your mortgage is going to be higher. Okay, so what I've done is I've just put the 3 scenarios down here so that you can kind of see the difference. I know maybe we're splitting hairs a bit. We're talking about a couple $1,000s over a year, but if you compound this over 25 years, I mean, you're talking about hundreds of thousands of dollars that are going to be getting saved here. Okay, so that's kind of what I wanted to show you guys in this video. Just stress having good credit is so important. It's going to save you so much money over your life, and over the life of your mortgage or any auto loans you have. It's important to pay on time. It's important to have a credit history. It's important to actually be using credits. If you're still using your debit card for some reason, please, I need to know what went wrong. Like, why are you using your debit card over your credit card? Start building your credits. It's going to, improve your financial scenario considerably. Like if we just compound this over 25 years, I mean, it's it's easy to see you're going to save like over $100,000. Okay. Moral of this video is start building your credit early and focus on achieving a good credit score. Not only is it going to help you improve your mortgage scenario, it's going to help you improve your auto loan scenario, or if you ever want to get into the real estate investment business and have like a rental property or anything like that, creditors are more likely to lend money to you if you have a good credit score, if you have a history of good credit, okay? And how long have you been paying down debt? Okay, and also, what is your total debt? Like, do you have consumer credit? Do you have auto loans, and how many? And what is your total loan to value ratio on your mortgage? Okay. Moral of the video: start building credit early. A good credit score is so important. Even if you don't realize it, you will one day. Okay, and that's pretty much all I have for you guys today. So if you guys enjoyed, subscribe to the channel, share the video with a friend if you learned something, and yeah, I'll see you guys in the next video. Peace.